The Bank of Canada stayed on hold and the Loonie moved up a little bit on that news. Here to explain what happened and what we should be watching for, we're joined by David Tulk. He is head of global macro strategy from TD Securities. So first off, let's start with the Bank of Canada. What happened?
Well, I think the bank met everyone's expectation. They kept rates on hold, and that really wasn't as much of a surprise as maybe some had expected. The bank would maybe try and talk down some of the strength in the currency. Remember, from the bank's perspective, a weak Canadian dollar is really important to help drive the rotation away from the energy sector back towards manufacturing and export activities. So, but at the end of the day, I think the Bank of Canada was comfortable with where oil prices sit, as well as where the currency stands, and as a result, they're sitting quite comfortably on the sidelines, hoping that at some point they get some fiscal stimulus from the federal government, which then alleviates the need for them to do more.
Let me ask, because I want to get to the fiscal stimulus, but on the Loonie, I mean, the Loonie is down significantly from where it was a year ago, but it's still up about, I think, 10% from the beginning of the year. So you think that the governor is comfortable with where it is right now? Because it seems to have even overshot, I think, where a lot of forecasters thought where the Loonie would be.
Yeah, I think it's overshot on both sides of the coin, to be honest. Where we saw the peak point of pessimism going into the January meeting was really the perfect storm, where you had oil prices falling quite sharply. The analyst community was split roughly 50-50 as to whether the bank would cut. So you couldn't get much more of a perfect storm for currency weakness, and the currency does tend to exaggerate moves in both directions. So the fact that we've come back from some of that pessimism, I think, is not too much of a surprise. And I think from the Bank of Canada's perspective, they don't want to get caught up in day-by-day or even week-by-week movements. They're going to take a much longer-term perspective, and there I think you need to look at the currency in the context of what we've seen over the last couple of years, and it has certainly weakened, which is very important from the bank's growth story.
They are, though, focused on March 22nd, of course, when the federal budget comes out, and stimulus, something they think that is the right thing for the economy right now. What do we need to see, do you think, from the federal government in terms of the kind of spending that's going to really help things move forward?
Yeah, I think it depends on the horizon to a certain degree. I think we would love to see a fair bit of infrastructure spending, which is a very good medium-term narrative for Canada, especially if you're working on improving some of the transportation infrastructure, education, healthcare, the whole gambit. But what we also, I think, want to see is a little bit of shorter-term stimulus, because the issue with infrastructure spending is it does take a while to ultimately help the economy. So to see a little bit more spending over a very shorter horizon, I think also gives the Bank of Canada comfort that not only is the long run going to be reasonably well supported, but they get a bit of a short-term lift as well.
All right, let's compare the Central Bank of Canada with the other central banks and what they're doing, ECB and the Fed. We're going to be hearing from them shortly. Let's start with the ECB. What do you expect?
I think the ECB had a chance in December to really provide a lot of stimulus, and we think that some of those themes will be echoed again tomorrow morning. It's an open question as to whether we get actually the true extent of the stimulus that we anticipate, because when we came up with that forecast, there really was a point of tremendous financial market volatility. So that's calmed down a little bit, which might remove some of the necessity for the ECB to do a great deal of support. But I think if you take a step back and look at the underlying data across the Eurozone, it remains fairly weak, especially on the inflation side. So there will be definitely more support coming from the European Central Bank. It just may not be as much as what the market hopes for.
Yeah, just like last time, the market was hoping for a lot. Let me ask you about the Fed then. The Fed has, of course, talked about being data dependent. I think the market's priced in a couple of rate increases in 2016. Do you think that's going to happen?
Yeah, we do believe in the narrative that the Fed can hike twice this year. I think really that will come down to a couple of different themes. That if you go back to the January Fed meeting, again, that was a moment of a lot of financial market turmoil. So they took a step back and said that they were going to revisit the balance of risk and try and figure out what that meant for their view. So the fact that financial markets have calmed down a little bit does allow them to shift their focus back to the conditions of the underlying economy. And here again, it's not wonderful news necessarily, but if you look at the progress that's taking place in the labor market, if you look at rates of inflation that have moved off of the floor, that I think does give the Fed at least some sense that the recovery is on track. And as long as we don't see a resurgence of more financial market turmoil or evidence that the rest of the global economy is slowing the U.S., the Fed can follow through.
Yeah, those are big ifs. We're going to have to watch that. David, such a pleasure. Thanks so much.
You're very welcome.